The healthcare space has been out of favor now for about a year, ever since Washington declared war on higher drug prices and Valiant, the once mighty pharmaceutical roll-up, started to collapse. Meanwhile, investors have been avoiding the more speculative biotechs, tend to trade based on their pipeline prospects, not earnings or dividends, which is what this market really likes, it craves. But what if there was a creative way to play a healthcare space, a company that benefits from the work being done in the biopharma industry in general, and science, to be a little bit more broad, that has the characteristics that are beloved by the stock market, namely a strong dividend yield? I'm talking about Alexandria Real Estate Equities, ARE. It's an urban office space real estate investment trust that specializes in owning science and technology facilities in what they call innovation cluster locations. Here we're talking about, of course, San Francisco, New York, Boston, Research Triangle Park in North Carolina. The idea here, it's at San Diego too, I should mention. The idea here is that life science and technology companies tend to cluster in certain areas, typically near major universities. Or, for example, you can't drive for 10 minutes in Cambridge, Massachusetts without going past the headquarters of some biotech company. And if you read today's New York Times, you might have noticed the piece about how even huge corporations are moving from the suburbs to major cities in order to attract the best talent. Alexandria invests in gorgeous, high-quality office properties in these research clusters. To follow up with that Cambridge example, just last month they shelled out $725 million for One Kendall Square complex near MIT. That's where Akamai is. A number of smaller biotech firms ply their trade. This has been a pretty solid business lately. It sports nearly a 3% yield. Stock's up more than 20% year to date. It has historically outperformed the whole market. That said, the company reported just last night, and while they delivered an inline funds from operations on higher than expected revenue, up 10.7% year over year, stock still got hit, down more than $3 today, or 2.73%. I think the weakness has less to do with the quarter, more to do with the fact the stock had run up mightily, and it was pretty much doomed to sell off no matter how good a number reported. Let's dig deeper here with Joel Marcus, the founder, chairman, and CEO of Alexandria Real Estate Equities. Learn more about his company and its prospects. Mr. Marcus, welcome to Mad Money. Good to see you, sir.
Thank you.
Have a seat, Joe. Have a seat. All right, Joe, the Times article was very interesting because they talked about the notion of the great, expansive suburban campuses that were gorgeous, and then people want to go urban. But I don't think they want to lose that kind of gorgeous suburban aspect with the gardens and the trees. You seem to be able to combine them both.
Indeed. In fact, I've brought you some peppers from the largest urban garden you may not know about here in New York City. At the Alexandria Center for Life Science, where we've taken what was a contaminated laundry site. Some years ago, Mayor Bloomberg asked us to build almost 1 million square foot campus, and we've inhabited some of the best of breed biotech and pharma in this campus with the most amazing amenities, including the largest urban garden in the city.
Those of my generation we didn't care what it looked like. We just were in it to be able to make some money or, historically do better than our parents. This new generation of smart people seem to want a little more than just the money, and Alexandria gets that, right?
Well, I think the most important thing is if you think about 10 years from now, not too far away, 75% of the workforce will be millennials. So we try to stay ahead of the pack, and we have thought about the urbanization trend back for the last decade. So we positioned the company in San Francisco, in Cambridge in particular, and in New York City, among the major cities, to be the dominant force in collaborative urban science campuses with these great amenities. From urban gardens to great restaurants. We have Tom Colicchio Restaurant. You're a restaurateur here in New York City.
Not in his class, but I appreciate that.
To some great fitness centers, to collaborative workspaces where scientists and others have a chance to have that collision, that interaction, that kind of collaborative, innovative spark that really makes great science.
Okay, so you guys have more disclosure. You're unbelievable. You have everything, and I really love your transparency.
Thank you.
But I was thinking if I was a builder, I would say, okay, listen, I'm going to do exactly what Alexandria does. I see what they do. I've got the blueprint. What keeps other companies from duplicating your really kind of great message?
Well, on the disclosure, we're the proud recipients of our industry, National Association for Real Estate Investment Trusts, 2 years in a row, the Gold Award for Best Disclosure.
Absolutely.
So that's a wonderful thing.
Right.
So we've created a moat. This was a garage startup a little over 20 years ago, when no one even looked at this sector, and we've created a dominant footprint in the major urban centers with these campuses, with the great amenities, but all in very high barrier to entry markets. So if you were to come into Cambridge today, packing $1 billion, it's hard to buy. You'd have to ask MIT, are they going to sell? You'd have to ask Alexandria, other great landlords. There isn't a lot of product you can sell and not a lot of development capability, so high barriers to entry in each of these markets.
And you also seem to know your clients well. I know that Google was original client, and you seem to actually take a piece of some of these guys.
Yes, so we have an 11-person think tank, really research team inside the company that really looks into the future trends of our industry. They help us underwrite our tenants. That's why we have 53% investment grade tenants, kind of as good as it gets. And that helps us create this great tenant base. And also we spend a lot of time looking at future technology innovations. We did Google's first campus back in 1998. They were unknown really to the world. This is before they came public. We did their first campus and we asked Sergey Brin, could we make an investment? And we bought some stock at $1 a share. We still own a bunch of that today.
Does that accrue to the shareholders? Is that for the management?
No, it does. It's on balance sheet.
Okay.
Indeed.
Excellent. All right, now, listening to you, I'm thinking about when I was out at Apple. They have a beautiful campus, but they're going to be competitive against Facebook. Facebook is doing mixed use. They're actually putting dorms up. Is that going to be the future? And because we would love to be in an Alexandria dorm right where our work is.
Well, we've been asked to do that. We have a very important presence in Lake Union in Seattle, and guess who sits there? One of your favorites, Jeff Bezos and Amazon. We actually owned a site directly across the street from his office, and they came to us and were talking about maybe workforce housing. That's really not our unique niche.
Right.
So we actually sold it to a local developer who's doing workforce housing for Amazon. But I think over time, we built a 90-unit apartment building in Cambridge as part of our recent 2 million square foot development. We built it and then sold it off to a REIT. So we might build it, but we won't operate and own it because that's really not our sweet spot.
And I want to be sure people should recognize that you just bought Kendall Square, but you did an equity offering already. So it's not like you're going to be on and then the next thing we're going to hear is a giant equity deal in order to be able to raise the capital. You've done that already.
We did. We did in anticipation of the offering. Right. We didn't lower guidance. Usually when you have a big offering, you generally lower guidance because you have more shares outstanding and you have less earnings. We were able not to be able to do that because of our robust pipeline. We're going to grow top line revenues, Jim, in 16 and 17 over 35%. Very unusual for a REIT.
Totally. Now, I should point out in the talk about the garage startup, the company is up the shares are up 1,000% during the period. S&P is up 252%, Dow Jones up 276%, and many of the major caps that we talk about have performed far worse, although they did quite well too. That's Joel Marcus, Chairman and CEO of Alexandria Real Estate Equities. Nice combination of sustainability, both in earnings and what they're doing in their businesses. Stick with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.